All right, let's go ahead and get started. Today is Monday, April 10th. The class is being recorded here for YouTube. So today what I want to focus on is going over homework 10 and Amazon, and then setting you up to be able to do homework 11, which will be due next Monday. And also 2 weeks from today, you'll be doing your third group project presentation on Nokia. Okay, so if you haven't started working with your groups on getting the Nokia and presentation ready this week, you might want to make that effort to get that started. Okay, so let's get started by also just checking very quickly on the Bloomberg Trading Challenge. So this is section 301. So here would be the rankings as of today. Again, very important, you can't have more than $300,000 of available cash at any point. So again, everybody's complying with that. You need 10 longs the second half of the semester. Looks like all 6 teams have done the 10 longs in this section, so good job. And again, it's relatively tight in terms of portfolio values for performance between first and last place. We're still got about 4 weeks left in the competition. All right, questions about the trading challenge? Pretty straightforward. All right, so let's talk about Amazon. So for your as is, I did mine on Friday when their share price was 102.06. Basically, you should have gotten your model data, put it in the first tab, and the assumptions. Their last reported year was 2022, so we don't have to adjust that. On Friday, the Bloomberg WAC was 9.9%. For me, shares outstanding, 10.2 billion. That was the share price on my DES screen. These were the growth rates, revenue and EBITDA for the next 5 years from the EEO. These were the trading multiples from the EEO for 24 and 25 for EV to revenue and EV to EBIT, suggesting these long-term operating margins between 5.5% and 6.9%. And over here in ratios, they did not provide tax rate guidance into the future. I did a search for JP Morgan using the out year for JP Morgan. It was 8.6%. That's the number that I used. I set my EBITDA margin to 15% to get the EBIT into the range of 6.8. And then I solved for a G and ended up with a G around 8%. 8.1 was my G. Okay. I assume you have similar numbers? Yes, sir.
So when I did it Saturday, the WAC changed by 1%. What would cause it to change?
Well, remember, it's doing real-time CAPMs. So if the risk-free rate is changing at all, RF plus, as a matter of fact, you can see it right here on the WAC screen. If you go into, we'll start out with AMZN. WACC, Amazon WAC is based on 11% cost of equity, and they're 85% equity. So if you click on this, you'll see Bloomberg is using the yield of the 10-year treasury. That's changing throughout the day, even. It's also using a beta, and it's using a market risk premium. If anything about the market is changing with interest rates, it will update the WAC in real time because the cost of equity is going to be updated. So, you know, in today's volatile world where interest rates are actually changing day by day, you could get a slightly different WAC. I mean, it's not going to be like, it's not going to go for like 10 to 7%, but it could easily go, 10 basis points in a day. It's another reason why I encourage you to use screenshots. Okay. Yes, sir.
So when I looked on JP Morgan for the tax rate, I saw 8.6, but I also saw 7. So how do you pick between the two?
Well, when you saw 7, where was that number? For what year?
It was, I don't know, 2023 or 2024.
Okay. And was that like an older report, or is that the more recent?
It was the one from February 23rd or something.
Okay. Again, we're about to talk about tax rate in just a second, but as I said, the most recent report said 8.6. Now, somebody actually said they looked at the model in the JP Morgan further down, and the actual model of the JP Morgan wasn't using 8.6. It was using a higher number. Everybody use that number? What'd you use? 18%. Okay, so that would be the other thing, which is even in that report, they were using 18% in the model. Okay, and that's actually where I wanted to start. So this is the solution file I gave to the TAs. And I said start grading based on this, which means your G should probably be somewhere around 8% for your as is, right? However, yes,
The WAC, I use the annuity one. What is different from the MR and then the period?
what is different for WAC? I'm sorry, what WAC
The
did
WAC
you?
has got 9 since I get period for annuity.
What's different about the WAC? I mean, it's around 10%. What WAC did you use?
The period annuity 2022.
I'm sorry, I don't see what
So
you're,
this one, the period annuity.
the period annuity?
Yeah, I select the annuity. The A,
How'd you get 8 or not?
the A is where
How did you get that number to change?
here.
Oh, you changed the period?
Yeah.
Okay.
Is it okay with that?
Well, you're using, if you did period A means annual, as opposed to MR, which is most recent. Usually you do the current WAC, which is the most recent. You don't use an annual WAC.
Okay. Good.
Okay.
Thank you.
So, because that would have been the WAC as of December, as opposed to the WAC as of April. All right. But regardless, here's where I was going with this. So if you put in an as is that was close to this, you're going to get credit. That's the process we followed. This is the solution I started with the TAs. However, okay, before we do our bull and our bear, I want to talk about the reasonableness of the assumptions that we put in, okay? Because yes, we followed a process. Yes, we kind of plug and chug and we create the numbers, but do our numbers actually make sense? Like, do they make logical sense for the company that we're actually putting in, right? And so here's where I'm going with this. The tax rate. Now, he said 7 something, 8.6 JP Morgan. Do you really think Amazon's going to pay an 8.6% tax rate forever? Realistically, probably not. Okay, so if the corporate tax rate's 20-ish, right, and even tech companies seem to be paying a little bit less than that, but still they're probably not going to pay a 9% tax rate. And so our valuation and the G is based on that tax rate, and that's probably not a reasonable perpetuity assumption. Like, even when I've told you to use the JP Morgan report, what you've done under BRC, and the simple way on BRC is, like I said, there's a second search bar which just searches BRC for information. And I said here, if you just search for a tax rate, I said use JP Morgan as a proxy, but the point is, if you go to this JP Morgan report, which is from March 31st, they're using a tax rate, but the 8.6% in the tax rate they're using, you can actually see the report over here, if it's loading, is for the year 2024. Sorry, it's having trouble. There it is. It's for the 2024 year. Okay, it's not the perpetuity year. Now, in the past, we've said 2024 is representative of perpetuity, but the key word is representative of perpetuity. If the 2024 year is not representative of perpetuity, we need to put something that is more representative of perpetuity. Does that make sense to everybody? All right. Now, interestingly, if we then looked further down in the report under the adjusted tax rate, I believe down here in the out years, in this part of the report, Amazon is actually being listed as an 18% tax rate further down in the report. Okay? But here's the real point. Whatever the tax rate is, I don't think 8.6% is reasonable, and the G that's based on that is probably not reasonable. Okay? So if I were to go to my model, this is why I said you can't just purely plug and chug. You got to think about what you're putting in here. Okay? There's some art of valuation. It's not just pure quantitative. If I put in a more reasonable tax rate, so let's say I use, starting in 2025, 18%. for tax rate. Oh, sorry, 2025 tax rates here. Row 10. 18%. Notice my share price drops to 78 in my as is. Now you might say, gee, why did he put it in 2025? I'll give them credit. For the next 2 years, they're going to avoid paying a lot of taxes. All right, so the next 2 years, all right, maybe 9%. But it's not going to be 9% long term. Okay? And the number that matters most, because we're doing perpetuities, is column M. What's the column M? What's the 2028 tax rate and beyond? Okay? So I adjusted it in 2025. You could adjust it in 2028. But either way, you need to have a higher tax rate long term. And if we have a higher tax rate long term, we're going to get a lower share price. And that's the first important part I wanted you to understand about the Amazon assignment. Questions? Okay, so then the real question is, okay, given the higher tax rate and the lower share price, if I have to match these two share prices, what else should I adjust? Okay, so I have a couple things that I could adjust. One, do I need to adjust the WACC? I don't know. We started with the WACC the same. I'll leave that for the time being. Two, do I adjust the margins? Okay. Now, right now, if I use the multiple EBITDA margin, I am at, which is row 7, I am at 15% in perpetuity, which is about where they are in 2023 and higher than they've been the last 5 years. Now they're seeing some improvement over the next couple of years, but the question is, are they going to maintain that improvement? Do I go even higher on the EBITDA margin, which means do I make this higher than 6.8%? Well, here, the multiple suggests 6.9 is the highest it should be, if I believe the trading multiples are accurate. So making that EBITDA margin higher to get back to 102 share price, like that starts to me sounding optimistic for another reason. Amazon by 2027 is going to be almost $900 billion in revenue. And at some point they're going to start maturing. There's a lot of competition for e-commerce. So the question is, are they going to get ever expanding margins in a tough e-commerce business? I don't think so. It's hard to imagine those margins are going to keep going up. So what I'm saying is closing that $30 share price gap to get to the as is by raising margins in perpetuity, that seems aggressive to me. So that leads to, what else do I need to potentially change? Well, the other thing I could change is growth. Well, right now, my G, before I made any adjustments, was already at 8% a year. And I'll go back to Amazon as a $900 billion a year revenue company. Do I think they're going to keep growing at 8% every single year going into perpetuity? That's like 80 to 90 billion of new revenue every single year. And I'm just saying, I'm not saying they're not going to grow, but it's hard to believe at that scale they're going to maintain that growth at that higher rate. Law of large number effect. We've talked about it before. This whole reason McKinsey says growth rates go down. And so my point is, it seems aggressive just to even have this growth rate, much less an even higher growth rate to close that share price gap. Okay, so I don't think I could justify, if I were just to talk it through, I could justify an even higher growth rate given the scale and size of Amazon and the competition that they're going to face in the e-commerce market. So how then do I close the gap? Well, I started looking at this, and then I started thinking about the WACC itself. Yes?
So with a higher growth rate, how high do you need?
Well, we could solve for that. To get this to 102.06, tools, goal seek, set sell share price to 102.06 by changing the G. $8.7. And I'm just saying, at this scale and this size, growing at 8.7% a year just seems optimistic, right, for a company of that scale. Okay, so I'm not saying it couldn't happen, possibly could, but it's getting harder and harder for me to, when I speak it out loud, to pass the smell test. So that leads me to, is there something else that I could change? And one of the other drivers is WAC. So what I did is I went back to Bloomberg, went back to the BRC screen where we had searched for tax rate, and I just put in a search for the WAC. Are the analysts estimating a WAC publicly? What might they be estimating? And the latest report that had WAC referenced into it was from March 27th. So I clicked on this report from March 27th from Needham, the bank. And what they were doing is they said in their DCF model they're using 8% for their WAC, not 10. Okay? So we got a Wall Street bank about 3 weeks ago that they did a DCF valuation of Amazon and they were using an 8% long-term WAC. And that's the point. What is a realistic WAC? So then I started thinking, see, why might they be using 8%, not 10%? So I went over here back to Bloomberg and I went to our WAC screen. And this is just important if you haven't already done this to understand how WAC is calculated. There's the current debt and equity mix based on today. Here's the cost of equity estimated today. There's the cost of debt. Cost of equity is CAPM. If you click on the 11% here, it brings up the CAPM that Bloomberg actually used. Okay, and so that risk-free rate is today's risk-free rate, 3.41%. Okay, that seems like the one to use. That's 10-year Treasury. That is the equity premium in the U.S. They're using 5.84% as their RM minus RF today. And Chicago said 6% plus or minus a little bit is typically the long-term risk premium, so 5.84 seems reasonable. But the real question is this 1.3 beta. Right now, Amazon's beta is 1.3. Now remember that beta is based on 2 historical years. Okay? And so the question is, does that past 2-year period represent that company's future? And what I would posit to you is I'm trying to interpret the Needham at 8%, is what they're saying on Wall Street about Amazon is that 1.3 beta is probably too high a volatility for Amazon going forward. It's probably not that high. Because if most of their business is retail, I'm not saying they don't have a higher beta, but we know by looking at retail betas, they weren't 1.3. They were a little bit lower. So if I actually put in a beta closer to 1, and I update this, then their WAC would be 8.4 today. So what I think Needham did, and Wall Street might be doing about Amazon, is that they're basically saying that the past volatility in the last 2 years is not representative of their future volatility, and the current WAC might be overestimating Amazon's risk, right, because of that excess beta. And if I put in a more realistic retail-like beta, then they start having a WAC that's a little bit lower. Okay? So 2 changes to your homework 10. Right? Change number 1 is the tax rate was too low. Just clearly too low. I need a more realistic tax rate. Change number 2 is I think the beta, therefore the WAC, might have been too high. And so, because that's the point. Like if we looked at a company like a Walmart and we did an RV, and we did our RV markets beta, and we looked at the industry of discount retail for the beta, these betas generally industry average 0.83. Okay, so if I think Amazon's got a little tech in it, it's got Amazon Web Services. Tech companies generally a little bit higher betas than retail, so I could blend the 2. But given most of their revenues coming from retail, I could make an argument that I think 1 versus 1.3 might be a more realistic beta, closer to that 8% WAC. And I think that might get me to a more reasonable valuation. So here's the point. If I were to switch Amazon's WAC to 8, I'll use the Needham WAC. First of all, I can't have a 8.7% G because my G can't be higher than my WAC in a perpetuity. So the question is, what would that G become at this point? Well, if I go back to my goal seek, I'm going to set my DCF valuation share price to to 102.06 by changing the G at an 8% whack, and I don't know why it's having trouble, but it's going to be somewhere around I don't know, 5.8, 5.7, 5.9. It's going to be closer to around a 6% whack. Oh, my goal sequence had trouble there for a second. But the point is, it's going to be closer to 6% whack. Now, when I'm telling this story, do I think that Amazon's whack in perpetuity at that scale sounds more reasonable to be at 6% a year or 8% a year? 6 to me sounds a little bit more reasonable. Okay, even 6 seems aggressive for that size of a company. Right? Walmart's growing like 2-3%. Right? So that's the point. Like I think that this is how you start to get to Amazon's valuation in a more realistic way. We're still getting the same price, right? But if I'm paying higher tax rates with a lower G, I'm not going to want to raise the G, and I already think that their margin is not going to go too much higher than my other variables, the WACC, and I can actually make a case for a lower WACC. This is what I'll call the art of valuation, okay? Because sometimes you solve a calculation, but you go back and look at the data and you say, does what I solve for make sense? And what I think we started to do for homework 10 is, yes, you solve for it, and yes, you could create the current share price doing the process we followed, but did that actually give us the best explanation for what's probably going on with Amazon? And when I started to question it, the answer was no. So I think this would have been a better as-is valuation, something closer to this. I'm going to pause. Questions, comments? Does everybody understand what or why I did? Yes.
So, one of the reports they were talking about Amazon wanting to do share buybacks.
Mhm.
Would you lean more towards changing the WACC than going with the
Well, according to Modigliani Miller, share buybacks shouldn't really change the WACC because they should offset. Because as you have less shares, you have more debt. As you have more debt, debt holders charge a little more, which offsets the lower cost of equity. That's Modigliani Miller's theory. But the point is, it's not going to change it by 200 basis points. So I think that what's really not the whack by the debt and equity mix, I think it's really going to be more the beta. That's the cap out. But in either case, what we're really saying, if I just take a step back from all the math, is that Amazon at their scale is a little bit less risky than that whack represents. And so however I want to refine that, that's what I think gets me to a more reasonable long-term DCF valuation than what we turned in for the solution this morning. Because remember, you got to explain this in your assumptions, right? And the explanation shouldn't just be the math worked. Like that should not ever be your only explanation. It's got to make common sense when you say it out loud, right? To yourself, even before I present this. And this story, I think if I were to tell it, growing at 6% a year, 5.9% a year versus 8.1% a year, will sound more reasonable. Other questions, comments, make sense? So, good chunk of the time, you're going to do companies like Walmart, you're going to do companies like Procter & Gamble, you're going to do companies like Merck, and everything's going to work out fine, standard process. And the assumption of our process is that WACs are pretty stable over time, because the whole idea of an enterprise DCF, use the same WAC, and the market's got it right. You're going to make an assumption that the ROIC is easier to predict than the G, so ROICs are stable over time. So therefore, we solve for the G, and everything should work out. But every now and then, it doesn't. And this is an example of where it really wasn't with Amazon. And we had to kind of think through to say, all right, we solved for this. Did what we solved for actually make sense? And we had to make two changes. Tax rate didn't make sense. And I think the G that was eventually created by that didn't make sense. It was too high. And intuitively, based on what we read. Matter of fact, if you read about the BICO, one of the things you read about Amazon is realizing that there have been too much infrastructure for their growth. So they're cutting back. They're laying off workers. They're not expanding in DC with their East Coast headquarters. They've basically put a stop to that. Right? So in a way, they're kind of telegraphing that they're not going to grow as fast as the market thought they were going to. So in a way, it's reinforcing the whole idea that an 8% G is going to start coming under question. And so if I have a lower G, how do I get to the current share price? Something else the market must be thinking about. Otherwise, their share price will be a lot lower. So that would be the idea about a little bit less risk. So this is just something you always should be doing. You should always be thinking about the answers that your formulas calculate, and if the answers don't make sense, then think through what other answers might. And I know you're probably like, damn, just when I thought I had all this figured out, throws a curveball at me. All right, let's practice at another company. Hint, hint, on what you're about to do. So next 20, 25 minutes, I want you to do an as-is valuation of Ford, F-U-S Equity, the automaker. Okay? See if we can do an as-is valuation of Ford. And I'll alert you in advance, it's not going to be clean. And we're going to talk about it. And for those of you in the video, I'm going to stop the video, and I'll do another video when we start debriefing Ford.